So if you want to become a professional stock trader, you will have to master three skills. Number one, stock selection. Number two, trade execution. Number three, trade management. Now, what is stock selection? Well, this is all about filtering stocks in the stock market. So let's say I am trading the Indian stock market. There are more than 5,000 stocks in India. So how do I decide which are those three or four stocks which I want to trade on the next day? So every day I have to sit and filter these 5,000 stocks to select the best possible three or four stocks which I can put on my watch list for the next day for purchase. Okay, so that is the skill of stock selection. How do you go from 5,000 to three or four stocks? You look at any market in the world, there are thousands of stocks being traded. So how do you decide that? That is the skill of stock selection. Now, stock selection can be different for swing traders and positional traders. As a swing trader, I would only look at the technicals. I would give less weightage to the fundamentals. But as a positional stock trader, I would look at both the technicals and the fundamentals. I want a lot of factors in my favor if I'm planning to hold a stock for the long term. So, as a swing trader, what would I focus on? I would focus on stocks with good relative strength. So, stocks which are having relative strength of more than 80. So, these are stocks which are in the top 20 percentile when it comes to 52-week performance. Next, I would focus on stocks which are in the best industry groups. So, industry groups which are in the top 20 percentile in terms of their 6-month performance. Then I would focus on stocks which are in a confirmed stage 2 uptrend, which means the price is above the 50-day simple moving average, the 50 days above the 150-day simple moving average, and the 150 days above the 200-day simple moving average. Okay, that's a confirmed stage 2 uptrend. I don't want to buy a stock which is in a downtrend. I want to buy a stock which is already in an uptrend. Why is that important? It is important because Mark Minervini found out that the growth stocks of the past, 96% of the growth stocks of the past were already in a confirmed stage 2 uptrend before they began their full scale advance. So if you are buying a stage 2 uptrending stock, the 96 your probability, your odds are 96%, right? That the stock is likely to go up. The probability is not 96%, but the odds are in your favor. 96% of all the growth stocks of the past, which gave huge returns, all of them had these characteristics as as a common characteristic, that they were all in a confirmed stage 2 uptrend. Okay, so remember, 96% are the odds, it's not the probabilities. Okay, this is called as reverse factor modeling, where you go to history, you look at stocks that gave fabulous returns, and then you reverse engineer, or you look back to those stocks and see what characteristics they were displaying before they began their advance. And this is one of the characteristics: confirmed stage 2 uptrend. So remember, best stocks from the best industry groups which are in a confirmed stage 2 uptrend and forming a tight base on the right hand side. So we want price contraction and volume contraction in the base. Then we want a stock which has got institutional demand. How will you check institutional demand? If you have Market Smith, they give you the ratings. But if you don't have Market Smith, go to the weekly chart and check when the price goes up during a particular week, is the volume above average? When the price goes down during a particular week, is the volume below average? If that is true, then that stock is probably under accumulation. Okay. And of course, the price should be near the 52-week high. So if this is the 52-week high, then the price should not be more than 25% below the 52-week high. So let me repeat, as a swing trader, you would look for the best stocks from the best industry groups, which are in a confirmed stage 2 uptrend, forming a tight base on the right side, having institutional demand, and the price is near 52-week high. When all of these 6 criteria are met, that is a very strong candidate for a swing trade. That is how you select a stock. So if you have this kind of strict criteria, and by the way, these are all characteristics that were found in growth stocks of the past before they began their full scale advance, because this is reverse factor modeling. So rather than uh, relying on opinions in the market. We are relying on facts. We are relying on what the market has displayed in the past. So it's a scientific approach to selecting stocks. Now, but this is for swing traders. As a positional trader, you want more odds in your favor. So you put in the fundamentals as well. So you want accelerating quarterly sales growth. You want accelerating quarterly earnings growth. You want return on equity more than 17% and ROE and margins. You want expanding margins. So sales, earnings, margins, and ROE. These are the four things we look for. So for earnings, you look at quarterly earnings growth and annual earnings growth. For sales, you look for quarterly earnings growth and annual earnings growth. Return on equity, you look at more than 17%. Margins, you want margins to be expanding since past 5 or 10 years. Okay. If those factors also are true for a particular stock, which shows technical strength, that's a strong candidate for a positional trade. Okay. So that this is the subject of stock selection, and this should not take more than 2-3 months for you to learn properly, because this is what we are doing before we buy the stock. So, when you look at the stock market, you will be objective in your analysis because you don't have money at stake. At this stage of your analysis, there is no money at stake. You are just selecting stocks. It's like you want to buy a real estate apartment. So you go around town looking for real estate apartments. That's all you are doing. You have not bought anything yet. Similarly, stock selection, you can be very objective. You can be very strict with your criteria, and you can learn this skill. It should take you 2 to 3 months to properly learn this skill. And if you want to learn this skill properly, there is a playlist called as stock filters on my YouTube channel. So it has multiple filters. You could choose to use any of the filters or all of the filters you want. If you watch all the videos in that playlist, you will reach a level of skill where you could create your own custom filter to slice and dice the stock market on a daily basis. So that is stock selection. Number two, trade execution. So let's say you decide that you want to buy a particular stock after you have selected it, and you want to buy the stock at 100. Okay. Now listen to this very carefully. This is extremely important. Trade execution, a lot of people fail at trade execution. Okay. And I will tell you the reason why. Let's say you want to buy a stock at 100. So the first thing you have to do is you have to place a alert at 99 or 98 probably, just near the your actual buy point. So that when the stock actually begins to move up on high volume, when it touches 98 or 99, you will get an alert on your mobile phone or on your desktop application. You will get a sound alert. That alert tells you that you need to be in front of the chart right now, because timing is key when it comes to trading. So you have to be, once you get the alert, you have to be in front of your laptop or your desktop or your mobile phone application. There is a trading view application on the mobile phone. You can use that as well. Once you get the alert, you come to your desk, you look at what is happening on the 15-minute, 30-minute, and the 1 hour chart. See whether volume is coming in or not. See whether the volume is above the blue line. The blue line is the 50-period simple moving average. If the price breaches your yellow line means the price at which you want to buy, which is 100 in our case. So if the price breaches 100, it goes to 100.01 or 100.05 or 100.10, depending on the tick size. If it trades one tick above the 100, okay, or whatever your price, if it trades one tick above that and you see good volume coming in, you can place your market order quickly, because you don't want the price to exceed beyond 1% from your buy point. So if 100 is your buy point, you will pay a maximum price of 101 for the stock, which is 1% above your buy price. If the price exceeds 101, do not buy the stock. Let it go, because there is no point in buying a stock that is extended in price. Imagine a stock, you want to buy it at 100 and now it sits at 105. You already lost 5% of return. Now you can't buy the stock at 105. That's the wrong price to buy, because you are buying an extended stock. Then if you buy it at 105, then your stop loss is going to be 8% below 105. You can't keep a stop loss below 8% below a price of 100. Okay. So we need to make sure that we don't buy a stock which has extended beyond 1% from our buy point. So between 100 and 101, I would try to accumulate all my shares. So if I want to buy, let's say, 1,000 shares of a company and it hits my yellow line, I would buy 500 shares. Then I would buy another 100 shares. As volume starts coming, I will buy another 100 shares. So quickly, within a span of 3 to 5 minutes, I would like to accumulate all my 1,000 shares within that 1% range. Okay. With multiple market orders. This is exactly what Mark Minervini is doing. And Mark Minervini is a two-time US investing champion. So please understand what I'm saying here. The first step is putting an alert. Second step is once you get the alert, come immediately in front of your screen. Look at the price, look at the volume on the lower time frame charts, 15-minute, 30-minute, 1 hour charts. Do you see volume coming in? Okay. Compare that volume on the daily time frame. Let's say that average daily volume is 1 million. And within the first half an hour, you have 700,000 shares traded. That's high volume. Okay. You don't need rocket science to figure out that in the first half an hour, you have more than 70% of average daily volume already logged in the market. Okay. That's a high volume. That is going to be a high volume closing day. So you have to buy. Okay. So mobile alert, then checking price and volume, putting multiple market orders as volume and price begin to move up, not buying extended stock. Okay. If you just keep these few things in mind, okay, that will allow you to keep a decent stop loss. Now your stop loss is 8% below your highest price that you have paid, which is not beyond 1% from your yellow line. So which means your stop loss is only 7% below your yellow line. Yellow line is your actual buy point, which is decent, which is consistent with what Mark Minervini and William O'Neill talk about in their books, that your stop loss should be 7 to 8%. So if you want to buy a stock at 100, draw a yellow line at 100 and draw another yellow line at 101, and then go to the 15-minute chart. And when the price trades between these two yellow lines, when the price is inside these two yellow lines, you can start putting market orders. That is a way of proper trade execution. This will take you another 2-3 months to master. So now you have selected a stock based on a certain criteria. Then you have done proper trade execution. Okay. You have not bought an extended stock. You tried your best to board the train, so to speak. Now comes trade management. And this is where trading becomes more of an art than a science. Because let's say you buy a stock, and let's say after 3 days, the stock is up 15% or maybe 20%. Happens in the market. Let's say the stock is up 20% in 4 days. What do you do now? You have multiple options. It is not black and white. See, in trade execution, it is black and white. You either buy or you don't buy. Even in stock selection, it is black and white. The stock either meets your criteria or it doesn't meet your criteria. But in trade management, it is not black and white. Let me explain. You buy a stock at 100. After 4 days, it's up like 20%, like it's gone to 120. Now you have multiple options. Number one option, sell all your shares. Let's say you have 500 shares, sell all your shares. Option number two, sell half of your shares. So out of 500, you sell only 250 shares. Option number three, sell only 25% of your shares. Okay. Option number four, don't sell anything. Option number five, move your stop loss to break even. These are just 5 options, okay, that I have told you based on what I recall. But there are infinite number of options, right? Because you could sell 10%, you could sell 15%, you could sell 37% of your shares. You can choose to do nothing. Okay. You could choose to move your stop loss from 8% to 4%. You could choose to move your stop loss from 8% to 3%. You could choose to move your stop loss from 8% to break even. You could even choose to move your stop loss from 8% to plus 10%. So you're trying to book profits. You're trying to ensure that you at least have a 10% gain in the stock. So uh, a lot of options open up for you when the stock begins to go up in price. That is where it becomes an art. Okay, that is where you have to begin calculate. That is where you have to get into mathematics. If you sell all your shares or partial shares, how much profit will you book? Can you use that profit to finance your next trade? Things like that. If the stock doesn't go in your favor, you know exactly what to do. You have your stop loss in place. Maybe you want to manage the risk tightly. So if the stock doesn't go in your favor, immediately after you buy, you would immediately start cutting your position. There are only two ways to manage risk. Number one, reducing your position size. And number two, moving your stop loss up. You would use those two tools to manage the trade if the stock doesn't go up in your favor. I generally like to cut my stop loss within 3% from my buy point. So if I buy a stock and instead of going up, it starts to come down, I immediately start cutting my position size. And by the time it's down 3-4%, maybe I have sold all my shares by that time. Okay. I never wait for the stock to come all the way down to 8% stop loss. That 8% stop loss is just for emergency in case if there is a falling window or some big event happens in the world and some disaster or catastrophe gets hit, the stock market could collapse. There could be falling windows on the stocks. So I don't want that to affect my portfolio. That is why that 8% emergency stop loss. But actually, when I'm trading, I'm cutting my losses very fast. So that those are what I call scratch trades. I have created 3 videos on scratch trades that I took recently. One was on Motherson, one was on Symphony, and one was on Camps. Go back to those videos and look at those scratch trade. See, scratch trading is an important skill. You might take 100 trades. Out of 100 trades, you might lose on 75 trades and win only on 25 trades. But you could still make money because 70 out of those 75 trades, most of them were scratch trades where you got out at break even or maybe 1 or 2% loss. But the 25 trades which you held on to, you probably held on to those stocks for a much longer period of time. Like one stock compensated for the loss you made on 20 other stocks. Okay. So even if your batting average or even if your win rate is very small, you could still end up making money because you are taking scratch trades. You are probing the market with your purchase orders. And if the stock doesn't do what you expect it to do, you are out of the stock very quickly on the same day intraday. Okay. So these are the 3 skills that you will have to master. So stock selection, then trade execution, trade management. I hope this video was helpful to you in your trading journey. So please support this YouTube channel. Please like, comment, and share this YouTube channel so that this type of content reaches those people who genuinely want to become professional stock traders. Once again, I thank you for taking the time to watch this video, and I hope I was able to contribute something to your trading journey. Thank you so much.